Welcome back to the deep dive. Today we are going to try to tackle this pretty substantial set of materials that the learner sent to us. You've really put together a pre-assessment that hits on so many financial management concepts. And then some study guides too, outlining some of these core principles.
Yeah.
And we were talking about, the basic mechanics of how markets work too, like valuing bonds, valuing stocks, managing investments, really smart ways to think about that. Capital structure, capital budgeting decisions,
Right.
Forecasting financials. You even get into private firm valuation, government regulation, the complexities of international finance, and then how to interpret those all-important financial statements and ratios.
Wow.
So our mission is really to dig into this, pull out the crucial insights, like those aha moments, and give you a solid, grasp of this stuff.
Yeah, what really strikes me here is just how much you've put together. It's really impressive, the breadth of information that you've
It's a lot.
you've clearly thought about this and want to dive deep. So I think our goal is to kind of connect these key elements and provide a framework for thinking about financial management, right?
Yeah, totally.
Yeah.
So let's unpack this. First, we should probably start with a pretty basic concept, right?
Mm-hmm.
What is the goal of a public corporation? What's the driving force behind their actions, at least in theory?
So the primary objective of a public company is to maximize shareholder value. Now, that might sound simple, but it has some pretty profound implications. It's like the compass guiding everything they do, from investments and risk to how they partner with other companies.
So it's more than just making sure that their stock price goes up.
Right. It's not just about making shareholders richer, although that's a direct result. It's about making the company more attractive to investors so it can grow and fund new ideas. And a financially healthy company, driven by this goal, it's in a better position to innovate, offer good products, create jobs. So while the focus might seem narrow, the benefits are pretty broad.
That makes sense.
Yeah.
You mentioned stock prices, which brings us to the idea of efficient financial markets. So how does a market being efficient or not affect how those prices are set? What does it even mean for a market to be efficient?
An efficient market is one where prices accurately reflect all the available information about an asset, like its true value. And there are a few things that need to be happening for this to work.
Okay.
You need lots of buyers and sellers competing. High liquidity is important. That means you can buy and sell quickly without really affecting the price. Transparency is key too. All investors should have access to important information about the risks and potential returns. And then, a certain amount of standardization in the securities themselves helps as well.
So if a market is efficient, how does that impact the financial decisions that companies and investors make?
Well, when markets are efficient, the prices we see are pretty reliable indicators of the underlying value. And this actually helps everyone make better decisions. For a company, if their stock price accurately reflects their future, they can make better decisions about raising capital, maybe issuing more stock when the price is high or investing in projects that'll generate good returns. And for investors, it means they can trust they're paying a fair price, even though, of course, there's no guarantee of future returns.
Okay. Are all markets equally efficient in the real world? It seems like it would be more of a spectrum.
Right. It's totally a spectrum. A good example of a highly efficient market is the market for U.S. Treasury bonds. They're super standardized, almost no credit risk, and their prices are available to everyone instantly. But then, the market for smaller, less well-known corporate bonds, that's less efficient. The risks can vary a lot between companies, trading volume might be lower, and not everyone might have the same pricing information. And this idea of how efficient markets really are, that's a debate in finance. And those imperfections are where smart investors can find opportunities and also risks, of course.
That's helpful.
Yeah.
So accurate pricing is a big part of efficiency. Now let's switch gears to a concept that really underpins a lot of this: time value of money. This feels like a basic building block.
It totally is. The core idea is that money today is worth more than money you'll receive in the future. $1 now is better than $1 later.
Because of things like inflation.
Yeah. Inflation definitely plays a role. Over time, the stuff you can buy with money changes, prices go up. But even without inflation, there's this thing called opportunity cost. The money you have today, you can invest it. And that money has the potential to grow over time. And this leads us to present value, or PV, which is what a future amount is worth today, and future value, or FV, which is what a sum will grow to in the future. And the interest rate is like the bridge between the two. It tells you how money changes over time.
Okay. And what are the things that determine those interest rates?
There are a few building blocks. You've got the real risk-free rate. That's like the return on an investment that has zero risk, and we're pretending there's no inflation. Then you add the expected inflation rate. That compensates investors for the fact that stuff will probably cost more in the future. And finally, you have the risk premium. That's the extra return investors want for taking on more risk.
Okay.
So the nominal risk-free rate, like what you see for U.S. Treasury securities, that's basically the real risk-free rate plus expected inflation. Corporate bonds, things that are riskier, will have that extra risk premium added on top.
Gotcha. And that risk premium, that ties into this idea of risk aversion, right?
Exactly. Most investors don't love risk. They'd rather have a sure thing, even if it means a little less potential profit. So they demand higher returns, that's the risk premium, to make up for the possibility of losing money. The way investors behave as a group determines what that required return should be. It all comes down to how risky they think things are. Like, imagine you could choose between a guaranteed $10 or a 50-50 chance of winning $20 or nothing.
Okay.
Most people would go for the guaranteed $10, right? That's risk aversion.
That makes sense. And there's a difference, isn't there, between risk and uncertainty?
Yeah, there is. Risk is when or at least have a pretty good idea of the chances of different outcomes. Uncertainty is when you're basically in the dark. You don't know how things are going to shake out.
Right.
A lot of financial decisions, especially when you're investing something brand new, that's uncertainty. And that's when an investor's personal risk tolerance really comes into play. Like investing in a big established company, that's a calculated risk. But putting your money in a startup, that's way more uncertain. You don't know if they'll succeed or flop.
Okay, so that makes sense. And this leads us to how companies get the money they need. Financing. We're talking about bonds versus stocks, right? What are the main differences from the company's point of view?
So when a company issues bonds, they're basically borrowing money. These bonds have a set value, a fixed interest rate, and a maturity date when they have to pay back the principal.
Okay.
Stocks, on the other hand, represent ownership in the company. Investors buy a piece of the company's future, their profits and assets. Dividends, those are payments based on the company's profits, but they're not an obligation. The company decides if and when to pay them. And unlike bonds, stocks don't have a maturity date. The investor makes money from dividends and hopefully by selling the stock at a higher price later on.
So for the company, what are the trade-offs between bonds and stocks?
Bonds usually mean more predictable payments for the investor. They get their interest regularly and the principal back when the bond matures. So because it's seen as less risky, the return investors demand for bonds is lower than for stocks. And this can make debt financing more attractive at first glance. Plus, in many cases, interest payments are tax deductible. That makes debt even cheaper.
Okay.
But those interest payments, they're an obligation. The company has to pay, whether they're making money or not. Missing payments can lead to bankruptcy. With stocks, the company has more flexibility. Dividends can be reduced or even eliminated if they hit a rough patch.
Okay, that's a good overview of how companies and investors work together in the markets. So let's dig into how these markets are structured. How does the buying and selling of these securities actually happen?
The financial market structure is essentially like the plumbing system connecting companies that need money with investors who have money to invest. Corporations issue securities like bonds and stocks, and then investment managers, like BlackRock, Fidelity, Vanguard, they manage huge amounts of money for their clients. They buy these securities.
Okay.
And then there are intermediaries like investment banks, JP Morgan, Goldman Sachs, especially in the primary market where new securities are issued. They help companies underwrite and distribute these securities. They often team up to handle large offerings.
You mentioned primary and secondary markets. What's the difference?
The primary market is where new securities are created and sold for the first time. This is where companies get money directly from investors. Like when a company goes public with an IPO, the secondary market is where those already existing securities are traded between investors. Think of it like you buy a stock from someone else, not directly from the company. Most of the trading action happens in this secondary market. And there are different types. You have auction markets, like the New York Stock Exchange, where buyers and sellers submit bids and offers directly. Then you have dealer markets, like NASDAQ, where market makers hold inventories of securities and make money on the difference between their buying and selling prices. And then there are electronic communication networks, ECNs. They basically match buy and sell orders automatically.
Okay. So why is that secondary market activity is so important? It seems like it's just investors buying and selling from each other, not directly benefiting the companies?
True. The company doesn't get money from secondary market trades, but it has two big benefits. First, it creates liquidity. Investors can easily buy and sell their investments, so they feel more comfortable putting money in the first place. And that makes it cheaper for companies to raise money initially. Second, all this trading helps establish accurate prices for securities. It reflects what everyone thinks about the company's value and the risks involved. And this information is super helpful for everyone making financial decisions.
Makes sense. So liquidity for investors and more accurate pricing, both very important. Now, let's talk about how to figure out what these securities are actually worth, starting with bonds. How do you determine the value of a bond?
Bond valuation is really all about time value of money. The price of a bond is the present value of all the future cash flows you expect to get if you hold it.
Okay.
And that includes regular interest payments, we call those coupon payments, and then the principal, the face value of the bond, that gets paid back when it matures. Usually that's $1,000 per bond.
Right.
To get the present value, you discount those future cash flows back to today using the investor's required rate of return. Basically, how much they expect to make for taking on the risk of buying that particular bond. We call that the yield to maturity, or just the yield.
And we always hear about this inverse relationship between bond prices and yields. Why is that?
Right. So the future payments for a bond, the coupons and the face value, those are usually fixed.
Yeah.
But if the required return that investors want goes up, then the present value of those fixed future payments goes down. And that means the bond price falls. And the opposite happens if yields go down. Think of the yield as the discount rate in our present value calculation. Higher discount rate, lower present value, always. And this is really important for understanding how macro events, like when the Fed raises interest rates, how that affects all sorts of investments.
Okay. So what are some of the important things about a bond, legally speaking, that we need to know to figure out its value? You mentioned face value, coupon rate.
Right. All the key details are in the bond indenture. That's the legal document.
Right.
And it's legally binding on the issuer. So you've got the face value, the principal repaid at maturity. Then there's the coupon rate, which determines the amount of those regular interest payments. Usually it's a percentage of the face value.
Mm-hmm.
And then you have the schedule for those payments. Most corporate bonds pay twice a year.
Okay.
And then the maturity date. That's when the bondholder gets the face value back. All this information is crucial for figuring out the expected cash flows and therefore the bond's value.
Right. It all goes back to those cash flows.
Yeah.
And we have some pretty handy tools for time value of money calculations. Are there specific Excel functions that are useful for valuing bonds?
Yeah, Excel has a bunch of built-in functions that make it way easier.
Okay.
To find the present value, which is basically the bond's price, you use the PV function. You input the yield, the number of periods until maturity, the coupon payments, the face value, and whether the payments are made at the beginning or end of the period.
Okay.
And the other way around, if you know the current price and all the other stuff, you can use the rate function to figure out the yield.
Yeah.
It's really helpful for comparing different bonds.
So we talked about how market efficiency affects prices in general. What are some of the risks that can impact bond prices specifically?
Two big ones are market risk and credit risk. Market risk is also called interest rate risk. That's the risk that interest rates will change, and that'll make the bond price fluctuate. Longer-term bonds, they're more sensitive to interest rate changes because they have more future payments, and those payments are affected more by how much you discount them.
Right.
Then there's credit risk. That's the risk that the company issuing the bond won't be able to pay their debts. Maybe they miss interest payments, or worse, they default completely and don't pay back the face value. And if that risk is higher, investors will demand a higher yield, which pushes the bond price down.
And what are some of the specific things that affect the yield that investors want for a bond?
A few things. The most important one is the yield on U.S. Treasury securities with similar maturities. That's basically the risk-free rate, right?
Yeah.
Then there's the credit risk of the issuer. Less trustworthy companies have to offer higher yields to compensate for the risk. Market risk, as we said, plays a role too. Longer maturities generally mean higher yields.
Okay.
Then, if the bond is backed by collateral, that lowers the risk. And finally, there's the tax status. Some bonds, like municipal bonds issued by local governments, they're tax-free, so they can offer lower yields compared to bonds that are taxable.
That's really helpful. So we've covered bond valuation. Now on to something that seems a bit trickier. Stock valuation. How do we even begin to figure out what a stock is actually worth?
It's similar to bond valuation in that it's all about present value of future cash flows.
Okay.
But with stocks, Those cash flows are usually in the form of dividends and the price you might sell the stock for in the future. And because those are harder to predict than bond payments, it gets more complicated.
Okay.
We use a discount rate that's typically higher than for bonds because stocks are seen as riskier.
Got it. So there's common stock and preferred stock. Are they valued differently?
Yeah, they are. Preferred stock is kind of in between debt and equity. It usually has fixed dividends paid regularly, and these payments often have to be made before any dividends go to common stockholders.
Okay.
Sometimes if those preferred dividends are missed, they pile up and the company has to pay all the missed ones before they can pay common stock dividends. Preferred stock doesn't usually have a maturity date, and the holders usually don't get to vote on company matters.
Right.
If the company goes bankrupt, preferred stockholders are ahead of common stockholders, but bondholders still get paid first. Because of those fixed payments and no maturity, one way to value preferred stock is to think of it as a perpetuity. So the price is simply the annual dividend divided by the required return for that type of stock.
Okay. And for common stock, the kind most people think of, how do you approach valuation?
For common stock, those future payments, especially dividends, they're less certain, and they're usually expected to grow over time. So we use a few different frameworks to figure out the value. Two of the most common ones are the CAPM, the Capital Asset Pricing Model, and the Gordon Dividend Growth Model.
Let's break down CAPM. What does that model tell us?
CAPM is mainly used to figure out the required return for a specific stock. You start with the risk-free rate, usually the yield on a long-term government bond.
Okay.
Then you add something called the market risk premium. That's the extra return investors want for investing in the stock market as a whole compared to a risk-free investment.
Okay.
And then there's beta. Beta measures how much a stock's price tends to move relative to the overall market. A beta of 1 means it moves with the market. Higher than 1 means it's more volatile, and lower than 1 means it's less volatile.
So if you're trying to build a portfolio that doesn't swing up and down as much, you'd look for stocks with lower betas, right?
Exactly.
So CAPM essentially gives us the right discount rate to use when we're trying to value a stock.
That's right. It considers the systematic risk of a stock and gives you the return that investors need to be happy holding it. And then you use that return in other models, like discounted cash flow models, to get an actual price.
Okay. And then there's the Gordon Growth Model. How does that work?
The Gordon Growth Model assumes that a company's dividends will grow at a constant rate forever.
Okay.
And the formula for the stock price is the expected dividend divided by the difference between the required return and that growth rate. It's a pretty simple way to connect a stock's value to its future dividends.
So what are the pros and cons of using CPM versus Gordon Growth?
Well, CPM is based on modern portfolio theory, and it explicitly takes into account a stock's risk relative to the market.
Okay.
The problem is, accurately estimating beta can be tough because it often relies on past stock price data, which may not predict future risks. And CAPM only gives you the required return. You still need to plug that into another model to get a price.
Wow.
Gordon Growth, on the other hand, directly estimates the stock price based on dividends and growth. But it's based on this idea of constant dividend growth, which is unlikely for most companies.
Yeah, that's a big assumption.
Exactly. So they each have their strengths and weaknesses.
So let's say we have these tools to figure out a stock's worth. From an investment management perspective, how do investors actually use these in their strategies?
The basic idea is to compare the current market price of a stock to what you think its intrinsic value is.
Okay.
Like the price you calculate using those models where the expected return matches what investors demand.
Right.
So if you find a stock trading below its intrinsic value, it might be undervalued and could go up in price.
Okay.
On the other hand, if it's trading much higher than its intrinsic value, it might be time to sell.
And we hear about prudent risk and diversification all the time. What do those actually mean for investors?
Prudent risk is about choosing an appropriate level of risk for your specific situation. Your finances, your goals, how long you plan to invest, and how much risk you're comfortable with.
Well,
It's about balancing potential rewards with protecting your money.
makes sense.
Diversification is a way to manage risk. Don't put all your eggs in one basket.
Right.
You spread your investments across different types of assets like stocks, bonds, real estate, and within those categories, different sectors, industries, even different countries. The main goal is to reduce idiosyncratic risk. That's the risk tied to a specific company, like a scandal or a natural disaster affecting their factory. If you're diversified, one bad event won't tank your whole portfolio.
Okay.
But remember, diversification can't eliminate systematic risk. That's like market risk, broad risks that affect everyone, like a recession or a war.
So how does beta from CAPM fit into all of this?
Beta, remember, tells you how much a stock's price moves with the market. In a diversified portfolio, it helps you control your overall market risk. If you have a portfolio with mostly low beta stocks, it'll be less bumpy, less affected by those big market swings.
Got it.
So someone who's more risk averse might prefer a lower beta portfolio.
And you mentioned correlation. How does that work with diversification?
Correlation measures how closely the prices of different assets move together.
Okay.
If the correlation is high, they tend to move in the same direction. Low correlation means they move more independently.
Okay.
The magic of diversification comes from combining assets with low or even negative correlation. So when one investment is down, another one might be up, balancing things out.
So is there like a concept that describes the ideal mix of risk and return?
Yes, it's called the efficient frontier. It represents portfolios that give you the most return for a certain level of risk, or the least risk for a certain expected return. These portfolios are all plotted on a curve. Anything below that curve isn't ideal because you could get more return for the same risk or less risk for the same return.
Okay.
The goal is to build a portfolio that's on that efficient frontier. That's where you're getting the most bang for your buck, risk-wise.
Okay, that's super helpful.
Yeah.
Now let's talk about how companies decide how to finance their operations and growth. That's capital structure, right?
Yes, they need to figure out the best mix of debt financing through bonds and equity financing through stocks.
Okay.
The goal is to find the combination that minimizes their cost of capital and maximizes their overall value.
So how do the costs of debt and equity play into this?
Usually, debt financing is cheaper than equity financing.
Okay.
Bond investors demand lower returns because it's less risky. And for the company, interest payments are often tax deductible, which makes debt even cheaper.
But there's a downside to too much debt, right? Financial leverage.
Exactly. Leverage is about how much debt a company uses compared to its equity. Using more debt can boost profits in good times because of that lower cost. But it also increases risk.
Okay.
Debt comes with mandatory interest payments. You got to pay them no matter how the business is doing. And those fixed payments make profits more volatile. In good times, it amplifies the gains. But when things are tough, those fixed payments make the losses even bigger.
So how does that affect investors and the company's value?
Higher volatility means more risk for investors. And if investors perceive more risk, they demand higher returns. So even though debt might seem cheaper initially, too much of it can make the overall cost of capital higher than if they used less debt.
So there's like a tipping point where more debt is actually bad.
Right. A bit of leverage can be good, but too much is harmful. It's all about balance.
So how do companies manage their capital structure to find that sweet spot?
It's a dynamic process. Companies might recapitalize, which means changing their mix of debt and equity. Like, if they think they have too little debt, they might issue more bonds and use the money to buy back some of their stock. Or if they have too much debt, they might issue stock to pay down some of those bonds.
And what factors do companies consider when making those decisions?
Many things. How stable are their sales? Companies with predictable sales can handle more debt. How much of their costs are fixed? Companies with lots of fixed costs might want to use less debt to avoid those big swings in profit. Their tax rate matters too because of those tax deductions on interest. Bigger companies often get better deals on debt. And of course, the company's management, their risk tolerance plays a role.
Okay. So we've talked about how companies get money. Now let's talk about how they spend it. Capital budgeting.
Right. That's how companies decide which long-term investments to make. The idea is to invest money now to get more money back in the future, creating value for the company.
Right.
They might buy new equipment, build new factories, expand into new markets, or develop new products. They have to estimate all the cash flows involved and use different methods to figure out if it's worth it.
So what kinds of cash flows are involved in capital budgeting?
There are three main types. First, there's the initial outlay. That's all the money you spend up front to get the project going. The purchase price, shipping, installation, any increase in working capital needed to support the project.
Okay.
Then you have the differential cash flows. Those are the ongoing cash flows generated by the project over its life. You can estimate those by taking the projected net income and adding back any non-cash expenses, like depreciation.
Okay.
And finally, there are the terminal cash flows. Those happen at the end of the project. That could be the money you get from selling the assets, any taxes you have to pay on that sale, and the recovery of any working capital.
So once they've estimated all those cash flows, how do they actually decide if it's a good investment or not?
There are a few key methods. The most popular ones are internal rate of return, or IRR, and net present value, or NPV.
Okay.
The IRR is the discount rate that makes the net present value of all the cash flows equal to zero. If the IRR is higher than the company's required return, it's a good investment. NPV is simpler. You calculate the present value of all the future cash flows, discounted using the company's cost of capital, and then subtract the initial investment. If the NPV is positive, it's a good investment. It means the project is creating value.
And what's this cost of capital you keep mentioning?
It's the minimum return a company needs to earn on its investments to satisfy its investors, both debt holders and equity holders. It reflects the risk they're taking.
Okay.
There are two ways to think about it. If you're looking at cash flows before interest expenses, you use the weighted average cost of capital, or WACC. That's the average return required by all investors, taking into account the mix of debt and equity.
Okay.
If you're looking at cash flows after interest expenses, you use the cost of equity, which is just the return required by shareholders.
Got it. Are there any other capital budgeting methods companies use?
Yeah, a couple of simpler ones. The payback method looks at how long it takes to recover the initial investment, but it ignores time value of money, so it's not great. And the profitability index, PI, compares the present value of the future cash flows to the initial investment. If it's greater than 1, it's a good sign.
So we've discussed long-term investments. What about planning for the future and managing day-to-day finances, financial forecasting and working capital management?
Right. Financial forecasting is all about predicting the future. How much revenue will they make? What will their costs be? How much cash will they generate?
Okay.
This helps them plan production, figure out what resources they'll need, and develop overall financial plans. Two key concepts here are discretionary funding needed, or DFN, and the sustainable growth rate, or SGR. DFN is basically how much extra money a company needs to raise to support its projected growth.
And the sustainable growth rate.
SGR is the maximum growth a company can achieve without raising more equity financing while keeping its debt-to-equity ratio stable. It tells you how much they can grow organically using their own profits.
So how do companies use these tools in practice?
They use them to create pro forma financial statements, which are basically projections of their future financials,
Okay.
and they figure out their discretionary funding needed. If their planned growth is higher than their SGR, they might need to change their strategy, like increasing profits, paying out less dividends, using more debt, or even raising more equity, though that's usually a last resort for public companies.
Okay, that makes sense. What about working capital management?
That's about managing the day-to-day stuff, making sure they have enough cash on hand to pay bills, collecting money from customers quickly, managing inventory efficiently, and strategically using credit from suppliers.
Right.
It's all about keeping things running smoothly and making sure they don't run out of cash.
So we're nearing the end here. Let's touch on a few more things. Valuing private firms, government regulation, and international finance. How do you figure out the value of a private company if their stock isn't traded publicly?
It's tricky because you don't have that market price to guide you.
Right.
One common way is to look at comparable public companies, or comps. You find companies in the same industry, similar size and growth prospects, and see how they're valued.
Okay.
You look at their ratios, like price to earnings, enterprise value to EBITDA, or price to sales, and apply those to the private company.
Okay.
There are other methods too, like looking at replacement costs or using discounted cash flow analysis where you forecast their future cash flows.
And what about government regulation? What are some of the key things to know about that?
Regulation is all about making markets fair, transparent, and safe.
Right.
Protecting investors from fraud and preventing things that could crash the whole system. We have the Securities Act of 1933, which requires companies issuing new securities to provide detailed information to investors. Then there's the Securities Exchange Act of 1934, which created the SEC to oversee the markets. Sarbanes-Oxley made companies improve their internal controls after some big accounting scandals. FINRA regulates brokers and their practices, and Dodd-Frank, that was passed after the 2008 financial crisis, addresses risks from big financial institutions and created the Financial Stability Oversight Council, or FSOC.
Okay.
These are just some of the key regulations designed to keep things fair and stable.
And lastly, international finance. What are some of the main things companies need to think about when doing business globally?
International finance deals with the challenges and opportunities for multinational corporations or MNCs, companies doing business in multiple countries.
Okay.
They often face risks like fluctuations in currency exchange rates, economic problems in other countries, and political instability. International trade relies on foreign exchange rates, which can impact profitability.
Okay.
A weak home currency can boost exports, but a strong currency makes imports cheaper, which can hurt domestic producers. Governments might even devalue their currency to try to help their exporters.
Okay. So we can't wrap up without talking about financial statements and ratios. What are the main statements and what information do they give us?
Financial statements are how companies tell everyone how they're doing financially. Publicly traded companies in the U.S. have to file these statements with the SEC regularly.
Okay.
There's the balance sheet, which shows what they own and what they owe. The income statement, which shows their revenues, expenses, and profits. And the statement of cash flows,